Welcome. We are doing financial reporting and analysis, November 2015, question 5. This is a KASNEB question. The question is on group accounting, or what we call consolidated financial statement. Let us first go through the question. We go through the additional information, and then we answer the question. The following is the extract of the financial statement of A Limited, B Limited, and C Limited for the year ended 30th September 2015. Income statement for the year ended 30th September 2015. You have A Limited, shillings there in million, B Limited, and C Limited. You have revenue, cost of sales, gross profit, distribution cost, administrative expenses, finance cost, profit before tax, income tax expenses, profit for the period, and retained profit brought forward. Then you go to the statement of financial position as at 30th September 2015. You have A Limited, B Limited, and C Limited. Shillings there in million. Non-current asset, property, plant and equipment. You have your investment. Under the current asset, we have inventory, account receivable, cash and bank balances. Then you have total asset, equity and liabilities. You have capital and reserve. You have ordinary share capital, share premium, retained profit. Then non-current liability have loan from bank, and current liability we have trade payables, current tax, and bank overdraft. Then you have total equity and liabilities. Additional information. Number one, A Limited acquired 40% of C Limited on 1st October 2014 for shilling 700 million. A Limited also acquired 80% of the ordinary share of B Limited on 1st January 2015 at a cost of shillings 3 billion 430 million. The fair value of non-controlling interest as at this date amounted to shillings 800 million. Whenever you are given the fair value in a question, the fair value of the non-controlling interest, that automatically means that you will use the full goodwill method in computation of your goodwill on acquisition of a subsidiary. Number three, the fair value of B Limited's property, plant and equipment on the date of acquisition was shillings 210 million above the book value, with exactly 5 years remaining on the useful life of this property. During the year ended 30th September 2015, B Limited sold goods to A Limited for shillings 140 million. B Limited marked up the goods at 16 2/3% on cost. Half of the goods remained in the stock of A Limited as at the year end. As at 30th September 2015, A Limited owed B Limited shillings 80 million, while C Limited owed A Limited shillings 15 million. Goodwill was impaired as follows: B Limited 25% and C Limited 10%. Let us go to the working now. When I have a question on group accounts, or what we call consolidated financial statement, I usually like to start working on goodwill first. So we can start with the goodwill. when we start with the goodwill, we first check the date of acquisition. We first start with the working of the goodwill of the subsidiary. The subsidiary here is B Limited because A Limited acquired 80%. So that is 50 plus 1%. Therefore, that is a subsidiary. And A Limited acquired 40% of C. Therefore, C is an associate because A Limited control a percentage which is below 50%. Therefore, that is an associate. They control a percentage which is below 50% but above 20%. Therefore, that is an associate. So we can start with the goodwill. We have said that when we are given the fair value of the non-controlling interest, we will use the full goodwill method. Therefore, let us first check the date of acquisition. The date of acquisition of B Limited is 1st January 2015. That is the date of acquisition. Let us check the date at which the financial statement of A Limited end. The date, the accounting year end of the A Limited. A Limited is the parent in this case. The year end at 30th September 2015. Therefore, it means that A Limited acquired B Limited in the somewhere in between the period. It did not acquire B Limited before the period. B Limited was acquired let us do the working. Let's do the working of the goodwill. We have the cost of investment. We have the cost of control in B Limited. We have the cost of investment. How much is the cost of investment? That is the purchase consideration that A Limited paid to acquire B Limited. We have been told that at a cost of shillings 3 billion for 30 million. So that's the cost of 3 billion for 30 million. Then we have the fair value of the NCI at acquisition. The fair value of non-controlling interest at this date amounted to 800 million. So we put 800 million here. We are using the full goodwill method, 800 million. If we add this together, we are getting 4 billion to 30 million. Then we go to the net asset acquired. We start with the ordinary shares. Ordinary shares of B Limited. The ordinary shares are 1,600 million. Then the share premium 300. Ordinary shares 1,600 million. Share premium 300 million. Then we have the increase in fair value of property, plant, and equipment in the working note. In the additional information, number 3, the fair value of B Limited property, plant, and equipment on that date of acquisition was shillings 210 million above the book value. Remember, on acquisition of a subsidiary, the asset, they are taken at fair value. They are taken at fair value. So this property, plant, and equipment, we add 210. That is the value at which the the property, plant, and equipment are above the book value. Then we go to the pre-acquisition retained earning. The pre-acquisition retained earning. That one we check in the income statement. You have the retained profit brought forward is 1,452,000,000. This was the retained profit brought forward at the beginning of that accounting period. At the beginning of that accounting period. And that, when is that accounting period beginning? The year is ending at 30th September 2015, which means that this is a retained profit brought forward. This is the retained profit brought forward at uh, 1st October 2014. At 1st October 2014. So we add the pre-acquisition. We have 1,452,000,000. Then we add now the profit for the 3 month up to for the 3 month up to the date when this subsidiary was acquired. That is the profit for October, November, and December, because this subsidiary was acquired at 1st January 2015. Therefore, those are our 3 months. So we put 3 out of 12 months. Then we multiply by the profit for that year of the subsidiary. We multiply by the profit. How much is the profit? The profit for the period is 2,152,000,000. 2,152,000,000. 2,152,000,000. 2,152,000,000. And if we do that, we are getting the pre-acquisition retained earning, or the pre-acquisition profit, as 1,990,000,000. So we add this together and we deduct them from the cost of control. We deduct them from here, the cost of control and the fair value of the NCI. So we add if we add all this together, we are getting 4,100,000,000. So which means that our goodwill, 4 billion to that 1,000,000 minus 4,100,000,000, which means that our goodwill is 130 million. That is our goodwill. But remember, we were told that the goodwill was impaired by how much? From the additional information number 6. The goodwill was impaired as for B Limited 25%. So this goodwill is impaired by 25%. So impairment of goodwill in B Limited it will be 25. That is 25 out of 100. We multiply by 130, 130 million. Multiply by 130 million, and we are getting the impairment of goodwill as 32.5 million. So we raise the impairment of goodwill, that is 32.5, and if we do that, we will get the balance of the goodwill to be taken to the statement of financial position as 97.5. The impairment of goodwill of 32.5, we will take it to the income statement as an expense. So we are done with the computation of goodwill for the subsidiary. Now we go to the computation of the goodwill for the associate. The associate is C Limited. A Limited acquired 40% of C Limited on 1st October 2014 for shillings 700 million. So the cost of investment here is 700 million. Then the ordinary shares acquired, the proportionate of the ordinary shares acquired is 40%. So 40% multiplied by the number of ordinary shares in C Limited. How much is the ordinary shares in C Limited? It is 400 million multiplied by 400 million. If we do that, we are getting 160 million. Then we go to the pre-acquisition retained earning. So we check, when was this associate acquired? It was acquired on 1st October 2014. So it was acquired at the beginning of that accounting period. It was acquired at the beginning of that accounting period. So we just take the profit, the retained earning brought down, retained profit brought forward, that is 1250, that is 1,250 million, and we multiply it by 40%. We multiply it by 40%. So 40% multiplied by 1,250 million, and if we do that, we are getting 500. We are getting 500 million. We add them together and we deduct them from the cost of investment. We're getting 660 million, which means that our goodwill is 40 million. Then we calculate the impairment of that goodwill, which is the impairment of that goodwill. For C Limited, the goodwill was being impaired by 10%. 10%, we multiply by 40. We are getting that impairment as 4 million. So we are done with the goodwill for both the associate and the subsidiary. So we now go to revenue. We now go to revenue. Revenue for A, it is 9,120,000,000. For B, it is 4,940,000,000. For C, C is an associate, so we are not going to consolidate C. We are not going to consolidate C into B, but for C, we will work out just only one figure, which is called the investment in associate. The investment in associate, which is usually taken to the statement of financial position under the non-current asset. So we are only going to consolidate A and B. So our revenue here for A, it is 9,120,000,000. We add, remember the subsidiary was acquired on 1st January 2015, but the accounting year was beginning at 1st October 2014. Therefore, we are only going to consolidate from 1st January 2015 to 30th September 2015. Those are how many months? They are 9 months, 9 out of 12. We multiply by the revenue of B. Multiply by the revenue of B, which is 4,940,000,000. Then we deduct any intra-group sales. Was there any intra-group sales? During the year ended that's September 2015, B Limited sold good to A Limited. This is A Limited for shillings 140 million. B Limited marked up the good at 16 to 30% on cost. Have the good remain in the stock of A Limited as at the year end. So there's intergroup sales of 140 million, or what we also call intercompany sales. We eliminate them. We eliminate the intercompany sales of 140 million, and if we do that, we are getting 12,685,000,000 as our revenue. Then we go to the cost of sales. We go to the working for cost of sale. The cost of sale of A is 3,016,000,000. For B, it is 1,092,000,000. So we go to the cost of sale. For A, it is 3,016,000,000. We go for B. Now this one will it's called time apportionment. 9 months out of 12, you multiply by 1,092,000,000. We are getting 819 million. Then we less the intragroup sales. That one is 140 million. Intragroup sales of 140 million. Then we add the unrealized profit. We are adding the unrealized profit to the cost of sales so that it can be deducted from the revenue, because the unrealized profit is supposed to be deducted from the profit. So we add the unrealized profit, which is 140 million multiplied by 140 million multiplied by 16, 2 over 3, 16, 2 over 3 divided by 116 divided by 116, 2 over 3. We are dividing by 116, 2 over 3 because there was a profit. The goods were marked up. Let us see. B Limited marked up the goods at 16.2 over 3%. The goods were marked up. Therefore, this means this is the profit on cost. So to get the profit margin, it is 16.2 over 3. This one out of 100%, then you add 16.2 over 3, because remember the gross profit margin is equals to the gross profit markup over the gross profit markup over 1 plus the gross profit markup. That is why we are taking 16.2 over 3 out of 116.2 over 3, because that profit is on markup, not on margin. And so we multiply by a half, because half of the goods were remaining. Half of the goods are remaining. Therefore, we get our unrealized profit as 10. If you do that, you are getting your unrealized profit as 10 million. Then you add the depreciation. You add the depreciation under charge. The depreciation under charge. Where are we getting the depreciation under charge from? The fair value of B Limited's property, plant and equipment on the date of acquisition was 210 million above the book value, with exactly 5 years remaining on the useful life of this property. Therefore, it means that B Limited had a property which was 210 million below the fair value. So B Limited was calculating their depreciation on the book value. Therefore, they were not taking into account this to 10 million, which is above the book value. Therefore, we have a depreciation undercharge in B Limited, which now we are going to account it as an expense. So we add the depreciation undercharge. This is the depreciation of increase in fair value of property, plant, and equipment. So it is 210 million over the useful life, which we have been told it is 5 years, multiplied by 9 out of 12, multiplied by 9 out of 12, because 9 out of 12 is a period in which this subsidiary existed during that accounting period, during that accounting year. So if we do that, we are getting that 1.5. You add them together, you get your cost of sales as 4,330.5. 4,330.5. Then we go to working 5, share of post-acquisition profit in associate. So that is just 40%. Share of post-acquisition profit, that is just 40%, multiplied by the profit of the associate. How much is the profit of the associate? It is 1,888 million. $1,888,000,000. So we are getting the share of profit as 755.2 million. Then we go to distribution cost. We search the distribution cost of the distribution cost. For A it is 665, for B it is 428. $665 plus 9 out of 12 times 428 times 428, and if you do that, you are getting 986. 986. We go to the administrative expenses. We have for A it is 695. For B, 9 out of 12, we multiply by 170 million. And if we do that, we are getting 127.5. Then we add the impairment of goodwill. We added here. Impairment of goodwill in B Limited, as we have seen in our working one, is 32.5 million. And the impairment of goodwill in C Limited, that is the associate, in our working note number 2, is 4 million. So the total administrative expenses is 859. 859. We go to finance cost. Finance cost for A is 65. Then for B, we're going to take 9 out of 12. 9 out of 12 multiplied by 20 because the finance cost for B is 20 million. If we do that, we're getting the total finance cost as 80 million. Then we go to the income tax expense. The income tax expense for A is 1,660 million, 1,660 million. We add 9 out of 12, 9 out of 12 multiplied by 1,078,000,000 to get our total income expense as 2,468.5 million. And now we go to the post-acquisition profit of the NCI. The post-acquisition profit of the NCI. The post-acquisition profit is 9 out of 12. The post-acquisition profit is 9 out of 12. 9 out of 12, you multiply by 2,152,000,000. So this is the total post-acquisition profit for the whole year. So, and the post-acquisition period is 9 months. The post-acquisition period is 9 months. That is why we are doing 9 out of 12. That's why we are doing 9 out of 12 multiplied by 2,152,000,000 to get the post-acquisition profit as 1,614,000,000. We raise the unrealized profit. Unrealized profit, we have already calculated the unrealized profit. We have already calculated the unrealized profit. We have already calculated the unrealized profit here. It is 10 million. So we deduct 10 million and then we less depreciation under charge. The depreciation under charge. The depreciation under charge, that one we have also calculated. The depreciation is that 1.5. That one we have already calculated. That 1.5. So we get our adjusted profit as 1,572.5, 1,572.5 million. So the NCI share, or what we call non-controlling interest share, which is B Limited, is 20%. That is 20% of this profit now. 20% of that profit, which is 314.5. We are through with the workings which are affecting the income statement, so we can quickly complete the income statement. We can quickly complete the income statement. Revenue from working note number 3. It is revenue from working note number 3 is 12,685. 12,685. Twelve billion 685 million. Cost of sales from working note number 4 is 4,330.5. Whereas the cost of sale 4,330.5. Our gross profit is 8 billion 354.5. 8 billion 354.5. Then the share of profit in associate, that is C Limited, as we have done in working note number 5. Working note number 5 is 755.2 million. We add the share of profit in associate. 755.2 million. Whereas the distribution cost in working note number 6, that is 986, and the administrative is 859, finance is 80, income tax is 2468.5. $986, that's the distribution cost. The administrative expenses 859. The finance cost 80 million. So the profit before tax, is 7,184 million point 7. The income tax expense is 2,468.5. So the profit after tax is 4,716.2. 4,716.2. We raise the share of profit by the NCI. The share of profit by the NCI, now working note number 10, is 314.5 million. 314.5 million. So the group profit, or the share of profit by the parents, is 4 billion 4 4 billion 401.7 million, 4 billion 400 million and 1.7 million. We are done with the statement of comprehensive income for the year ended, that is September 2015. And now we go to the second requirement, which is the statement of changes in equity. The statement of changes in equity. The statement of changes in equity. We can start with ordinary shares. We can start with the ordinary shares. How much was the ordinary shares? Here we are just looking at the ordinary shares of the parent. The ordinary shares of the parent company. How much are they? The ordinary shares. The ordinary shares were 2,600,000,000. Share premium 1,500,000,000. And then the group profit brought down was 7,612,000,000. And then the favor of NCI was 800 million. That is so the ordinary shares, share premium, a retained earning, (7,612). Then we go to the group profit. From the statement of comprehensive income, the group profit from the statement of comprehensive income. Then we go to dividends paid. Dividends paid. Let us calculate the dividends paid. How do we calculate the dividend paid? We are going to take the retained profit brought down How much is the retained profit brought down? It is 7,6 12. That was the retained profit brought down by A Limited. Here we are only concentrating on A Limited, the parent. That was the profit brought down. Let us see from the income statement they had provided. This was the retained profit brought down. Then they added this profit. They added this profit. But the retained profit carried down was this one, 8,237,000. So if you add this retained profit brought forward, you add the profit for the year, then you're supposed to get this retained profit. But if you don't get this retained profit, then you know there were dividend which were paid. Let us do that. This was the retained profit brought down. We earned the profit for the year, 425. Then the retained profit carried down is 8,237. If we add this one together, we are getting 10,037, which therefore means the balancing figure here represent the dividend which were paid, because the dividend reduced the retained earning. So the balancing figure here represent the dividends which were paid. So how much is the balance figure? I'm getting 1,800 as a balance figure. So that is the dividend which were paid. $800. We remove the NCI. We are not going to put the NCI in the statement of changes in equity. Therefore, let me remove this row. Let me remove this row. Therefore, at the end, let me also remove this column here. Delete. Okay. The statement of changes in equity, ordinary shares, they did not change. Share premium did not change. And the retained profit, if we do this calculation, we are getting the retained profit as 10 to 13.7. 10 to 13.7. We are now done with the requirement B, that is the statement of changes in equity. And now finally, we go to the statement of financial position. We finally go to the statement of financial position. We can now deal with the workings affecting the statement of financial position. We can start with property, plant, and equipment. You are supposed to add them together. So A Limited property, plant, and equipment is how much? A Limited property, plant, and equipment. It is 6,096,000,000. For B limited, it is 4 billion 855. 4 billion 855. So we add them together. We add them together. Then we add the increase in fair value, that is of 210. Increase in fair value of property, plant, and equipment. And then we raise the depreciation of the increase in fair value of property, plant, and equipment. And the depreciation, we had calculated it, and we got that one, got that 1.5. If we do this, we are getting our property, plant, and equipment as 11 billion 129.5 million. 11 billion 129.5 million. Then we go to investment. The investment, A limited, we have 4 billion 350, and B we have 50 million. Investment, we have 4 350. We earned for B, it is 50 million. Then we raise the investment in the subsidiary. You raise the investment in the subsidiary. That is the cost at which this A limited acquired the subsidiary. You raise the investment in the subsidiary, 3 billion for 30 million, and you will also less the investment in associate, which is 700. That is the investment in associate. Therefore, you get other. These are now called the other investment, which is to 70 million. Then you go to the cost investment equity in associate. The cost of investment, which we have deducted here, is 700 million. That is 700. You add the share of post-acquisition profit, that is 755.2, and you raise the impairment of goodwill of the associate. The impairment of the goodwill of the associate, we got 4 million. No, here the profit you are adding, you don't put the bracket sign when you are adding. The bracket sign I'll put when you are deducting. So we get the investment equity in associate, which is C limited, is 1 billion 451.2. Then we go to inventory. We now go to the inventory. For A limited, we have 1 billion 460 million. 1 billion 460 million. Then for B, we have 853. and then we less the unrealized profit, which we had calculated as 10 million. Deduct the unrealized profit of 10 million. So the value of the inventory is 2,303 million. Then we go to the trade receivable. We have the trade receivable for A as 18,880. For B, we have 765. Then we list the intra-group trade receivable. B to A, let's see that additional information. As at 30th September 2015, A owed B shillings 80 million, while C Limited owed A Limited shillings 50 million. So for B to A, we have 80 million, but the intragroup for C to A, C is an associate. We only take the proportionate share of the trade receivable, the proportionate share of the trade receivable owing. So that will be 40%. Let's do our working here. 40% multiplied by 15. 40% multiplied by 15. So what is 40 times 15? 40 times 15. I'm getting 6 million. 6 million. So the balance, if we add this, we are getting 2,645. So the balance carried down of the trade receivable, the balance carried down here, we're supposed to get 2,645. Therefore, the balance carried down of the trade receivable is 2,559. 2,559. Go to the group retained profit brought forward. This one we have already done this one in this one we have already done it in the statement of changes in equity. Therefore, we are not going to do that one again. Then we have the NCI. The NCI, the fair value of the NCI at acquisition was 800 million. Then the post-acquisition share of profit from the statement of comprehensive income is 314.5. So the total NCI is 1,114.5 million. We are done with the NCI. It's as simple as that. Then we go to the trade payables. The trade payables for A, we are given as the trade payable for A. Let's check from the statement of financial position. The trade payables for A is 1,643 million, and for B is 646 million. 646. We deduct the intragroup. The intragroup owing A to B is 80 million, and A to C, we have calculated it as 6 million. So the balance carried down. So if you add this one, you are getting 209. Here you are also supposed to get 2109. So the balance carried down is 2023 or 2 billion and 23 million. We are done with the trade receivable. We are also done with the statement of changes in equity, and therefore we are done with the workings of the statement of financial position. So we go to property, plant, and equipment. How much is it? Working note 11, 129.5. 129.5. Investment, note number 12, investment at 270. Investment 270. Equity investment in associate, working note number 13. Uh, 1,451.2 million. $451.2. Then goodwill. In working note number 1, we got our goodwill as, let's check it. Goodwill 97.5. 97.5. 97.5. Remember here, you are not supposed to add the goodwill for the associate, because the goodwill, you're not supposed to add the goodwill for the associate, because for the associate you have calculated one figure, which is the equity investment in associate in working note number 13. So you're not supposed to add the goodwill for the associate, because the investment in associate is measured at cost, then you raise any post-acquisition changes. That is how you measure the investment in associate. So we are getting our non-current as 12, 9, 12, 948.2. That is our non-current asset. Then we go to the current asset. Inventory we have seen as 2,303. 2 account receivable 2, and the account cash at bank balances. This one we can add, we can calculate cash at bank balances. Uh, 1224, and 187. Total of 24. Total of 24. We add 180, 187. We are getting 1411. And if we add this together, our current asset, the total of our current asset is 2,273. 6,273,000,000. We add the current asset to the non-current asset, so the total assets are 19,221.2. 19,221.2. Then you go to equity and liabilities. We have ordinary share capital. This one are in the statement of changes in equity. So we have 2,600, share premium is 1,500, and the retained earning is 210 to 13.7. Share premium 1,500, and the retained earning 10 to 13.7. Then we have the NCI in our working number 17. We got 1,114.5 million. 1,114.5. So the total of the equity now is 15,428.2. 15,428.2. We go to the loan from the bank. This one we can just add, it is 650. That is for A, and for B it is 200, which give us a total of 8. Give us a total of 850 million. Then the trade payables, we have done a working of the, we go to the current asset. The current asset, we have the trade payables. We have done our working 18, where we got 2,023, 2,023, and then the current tax, we can just add. For A, it is 560, and for B is 360, which you get 920. If you add your current asset, we're getting 2,943. 2,943. So now we add equity These are current liabilities. These are current liabilities, sorry. So now you add your equity, then non-current liability, and the current liabilities to get your total as 90. Your total of liabilities and equity is 19 to 21.2. And as you can see, our statement of financial position has balanced. If you have any question, you can post it in the comment section below. And remember, we have prepared, we have done, our team has prepared all the answers for the financial reporting question from 2015 to 2023. You can buy those answers at cash 300 only, question and answers at cash 300 only from the link in the comment section below. Thank you very much.